Hi everyone, this is Ali Hussein Kasim of Ali Talks Tech. In this week's weekly roundup, I'm covering only two stories. The first one is the global AWS outage that affected different industries and different clients, and then it had a multiplier effect across the world. Back to that in a minute. And the second story I'm covering is a deep dive on the evolution of the agency banking network across Africa. And in this case, I'm going to cover three countries which I feel have different models, and those models could sort of be replicated or be looked at, and other African countries can learn from. Actually, the rest of the world can learn from. I'm going to look at Kenya, the home of agency banking. I'm going to look at Nigeria, and then I'm going to look at our neighbors in Kenya, Uganda. So first, back to the AWS outage that affected literally the whole world. 60 major brands across the world were affected, and it started somewhere in the US. And some of the brands that were affected included gaming brands like Fortnite, social media like Reddit, communications company like Zoom, crypto companies like Coinbase, banks like Lloyd's Bank, and guess what? Amazon.com itself. This disruption really originated from AWS's US East 1 region in Northern Virginia. And as you can imagine, because of the fact that AWS is such a humongous cloud computing player, with about 32% market share across the world. You can just imagine the tech companies that depend on AWS. I was personally affected because one of my favorite AI platforms, Perplexity, is actually hosted on the AWS cloud platform. And for a couple of hours, I could not really access Perplexity. This impact was worldwide. And you are talking about North America, Europe, Asia, and Africa, including, as I said, Kenya and East Africa. Interestingly, my cloud host, where I buy domains, Host Africa, was not affected, but they had an alert on their website speaking of potential disruption. So there are some lessons here. And the lesson for me, I don't want to go into the technical details. That one I leave to the hardcore cloud computing techies. What I want to say is, what I want to address is the business decisions that come with concentration risk. Concentration risk simply basically means that you depend on one particular service provider or customer, in this case, service provider. If your only cloud computing partner is one, and I don't necessarily mean AWS here because it can happen to anybody. Yeah, what I mean is, if you are fully dependent on cloud computing, you must have redundancy. You must have at least 2 or 3 service providers that can pick up the slack when one of your service providers goes down, especially when cloud computing plays a critical role in your operations. Lessons here. These things will continue to happen. It's not just cloud. It's not just AWS. A few months ago, we had a Google issue. It's general. Things happen. Prepare yourselves. Make sure that your cloud computing strategy includes more than one player. That's just the basics. Now, I want to talk about agency banking in Africa. A couple of weeks ago, the Central Bank of Nigeria issued a directive which was like detonating a bomb, if you like to ask me, in the midst of an interesting and growing fintech ecosystem. And the directive is very simple. By April 1st, 2026, that's next year, hardly 6 months from now, every agent who operates an agency banking business in Nigeria will have to focus him or herself on one service provider. Let me repeat myself. Every agent needs to be exclusive to one financial services brand. So, if you used to serve 5 different banks and fintechs as an agent, as an agency banking business in Nigeria, by next year, April 1st, you will have to have chosen one service provider. If you want to think about that for 1 minute, you had a business with multiple locations in Nigeria, and your core business was agency banking, and you had 5 different customers. What the Central Bank of Nigeria is basically telling you is choose one, be exclusive. So we'll come back to that story for in a minute or two in terms of what that means. But what that directive from the Central Bank of Nigeria got me thinking is, what are other countries doing? And when it comes to agency banking, the platinum standard, if I may say so, is Kenya. But there's also another country that you probably not thought about when it comes to agency banking called Uganda, our neighbor here in Uganda. These 3 countries have 3 distinct policy and regulatory strategies when it comes to agency banking. So let me break it down for you. To date, Nigeria has followed the playbook of Kenya. It has been super successful with 2 million agents in the financial services sector. 2 million agents, not bad. It was a free-for-all. It was an open market. You needed to follow prudential guidelines by the Central Bank of Nigeria. You needed to ensure that you had the specifics to the T as far as the Nigerian regulator and policymakers were concerned. But it was, as an agent, you could serve as many financial services brands as possible, just like in Kenya. What precipitated that is something we're going to discuss shortly. In Kenya, which is the home of agency banking, you generally have around 4 key players. You have Safaricom, and I'm mentioning these key players because they really control over 80 to 90% of agency banking footprint in the country. You have Safaricom with their mobile money, M-Pesa. You have KCB Bank. You have Cooperative Bank. And you have Equity Bank. These 4 financial services brands actually got their agency banking right. You have smaller other banks that have gotten into it, and KCB is now offering, since the acquisition of River Bank, which was the platform that they used, they are starting to offer agency banking services to other players. But Kenya's focus on agency banking has always been non-exclusive. The directive by the central bank back in 2014 was very clear. You will not be exclusive. You will not sign one agency banking platform or service agreement with one financial services player, whether it's Safaricom or KCB. And that has precipitated a very interesting growth in agency banking across Kenya. Banks like KCB and Equity Bank and Co Bank mobilize billions of shillings in deposits through agency banking, not to mention other auxiliary services. So Kenya's agency banking market is extremely dynamic. It's a free-for-all. But despite that, we're also seeing a situation where, because of these key players having specific network effects, if you want to call it, they have created almost natural moats where competition becomes very difficult. Now, let's move to Uganda. Uganda had is a very interesting model to think about. The Uganda Bankers Association, UBA, and a Kenyan fintech called Eclectics came together, formed a joint venture, and created the Agent Banking Corporation, ABC. The ideal situation where you have one platform owned by the Bankers Association, which is now opening it up to fintechs. They basically said, no, wait a minute. We do not want to have a situation where one agent has 10 PDQs. One serves KCB, another one serves Equity Bank, another one serves Coop Bank, another one serves Safaricom. So you walk into an agent and you have 4 different or 10 different gadgets, each one serving a different service provider. Becomes clunky, it becomes almost impossible for small agents to actually operate. The costs, the operational costs, the complexities of the technologies, the different technologies that are not interoperable becomes a nightmare. So Uganda said, no, we've seen what is happening in Kenya. I think we can do better. In Uganda, you have one ABC gadget that can serve any bank or any fintech. And I must say kudos to my good friends Paul Mbugwa and Sebi Salim, who were on my podcast about 2 years ago. They've done a fantastic job with this partnership with the Uganda Banking, the Agent Banking Corporation, ABC, which is a joint venture between them and the Uganda Bankers Association. So now I've printed a picture. You have 3 distinct models. 2 were the same, but why then has Nigeria decided, despite the success of the open market and non-exclusivity of the agent banking ecosystem in Nigeria, they've woken up one morning and said, wait a minute, we're creating systemic risk here. Fraud, service levels, anti-money laundering issues and stuff. And we don't seem to be able to control this. So they've gone completely left field and said, nope, we want to have visibility. Right now, we don't have visibility because these guys, it's a myriad of different technologies. It's almost impossible to police. So what they've decided is every agent would be exclusive to one service provider. So they've gone completely the other side. The Mobile Association of Nigeria is up in arms. They're saying this is going to create another effect. Instead of creating the right environment, it will now create monopolies. What are your thoughts about this? I think the jury is out because you have 1 year, Nigeria has 1 year to implement this. There's probably going to be lots of lobbying going on. My thoughts here is there could be a middle ground here, because going completely on the other side is going to disenfranchise quite a lot of people. These 3 models, Kenya, Uganda, Nigeria, are a very interesting case study. In Kenya, we have seen a complete open market, but the open market is actually being policed in courts by the market vagaries, where you have players like Safaricom, because of their market power and because of the fact that agents find the volumes coming through Safaricom are a lot more attractive than volumes coming from other players, they still prefer to give priority to the Safaricom brand, to the M-Pesa brand. But there are other operational issues that are starting to imagine the float. I don't know how many times you've gone to an M-Pesa or a banking agent and they've told you, Pole, sina float. So you've wondered, what has float got to do with the transaction. It's just the ability, the way the agents manage funds, the funds that are available in cash and the funds that are available in digital form. And if those sort of cross each other, that's where you find that somebody can transact, rather can receive money from you, but can't pay you. He may not have that money. So it's always a juggling balance. Now imagine you have 5 different floats to deal with. And that's why then the Ugandan model is fantastic, because you have one platform, you have possibly a couple of liquidity providers who plug in into that platform. These are positive from many angles. From the regulatory angle, because there's one window to see into what is going on. The other one is the ability to simplify your operations, float, reconciliation, and so on and so forth. And the third one, obviously, for the agent, it makes more business sense. You come in, you want bank X, you can um, transact. You want mobile money B, you can transact. You want mobile money C, you can transact. You want a fintech D, you can transact. So this is me saying that the Uganda model is probably the best model that countries need to look at. It creates a situation where players fight on service, not on technology, because the platform is the same. What are your thoughts, ladies and gentlemen? I want to leave it there, but watch out for the deep dive newsletter that is coming out this week on Ali Talks Tech. Asanteni sana.